And hello, everybody. My name's Gary Stockton. I'm here with Joel Pruis and Nate Kelly. Joel Pruis from our global consulting practice, and Nate Kelly from Moody's Analytics. Good morning, guys.
Morning.
Good morning.
And thanks for coming online with us today. We like to do these Google Hangouts following the quarterly business credit review, where we take a look at the health of small business credit. And we like to follow up the sessions with do a little bit of Q&A. We have enabled the Q&A app for this Hangout. So if you are in the audience and you have questions and you'd like to submit them live to our panel, by all means, send those through to us, and we will try and answer your questions. We've also got some other questions that were overflow from our webinar, which took place on the 10th. So I think I'm going to try and bring up some of the questions initially, and see if we can cover some of these. There were some questions about delinquency in Nevada, and can you see the chart on screen right now?
Not yet.
Not yet. Okay. Just bear with me here. How about now?
No, it's a screenshot.
Screenshot? Okay. All right. Bear with me then. Okay. Well, I think the technology is going to fail me today. I'll give this one more shot here. Maybe go to the live app, and we'll try and pull up Nevada and take a close look.
I can start to verbally address that if you'd like.
Yeah, if you've got the deck up on your side, Joel, by all means.
Yeah. So the current delinquency rate for the state of Nevada for the first quarter of 2014 was 7.72%. And just to remind everybody, delinquency is defined here any time beyond the due date of the particular payment. So it can be 1 day past due, and we're including it in the delinquency rate. So again, the most important part of this is to look at the relative nature of the delinquency rates and their trends. So Nevada overall was at 7.72%. The nation was at 14.29%. So just a little over half the delinquency rate of the nation. When we compare that to the rest of the western region, which does significantly better than the country overall, the West was at 7.37%. So just slightly above the regional delinquency rate averages, but significantly better than the nation. And we also look about a year ago, they were at, looks like about 7.2%, if I'm reading that, 7.5%. For first quarter 2013, that compares to 15.26% for the nation and 8.74% for the West region. So holding fairly steady. They did have a little bit of a dip down to 4.4% in the fourth quarter. There we go. So you can see the fourth quarter dropped down to about 4.4%, but overall staying fairly consistent with the West and significantly better than what we're seeing for the rest of the country.
Mm-hmm. Yeah, I'll toggle to delinquency rate here so we can kind of see that, and then I'm going to drill in on Nevada. I think Las Vegas, obviously, that would be the metro area, right, where most of the commerce is happening.
Right. Exactly. The one thing interesting to note is that, so we define delinquency as anything beyond the payment due date, and then you look at really how is the severity of the delinquencies, and that gets into the days beyond terms. Nevada, as you were showing there, is 10.6. The West region for the fourth quarter was 5.41, and the nation overall was 6. So decent compared to the West region, much better than the nation, as we're looking at the percentage of businesses that are going delinquent on their accounts. But the delinquency is slightly more severe than what we're seeing in the country as well as in the West region. So kind of a mixed bag there as far as the overall results.
Mm-hmm. Okay. Any thoughts, Nate?
Well, I was going to just say that that Vegas is climbing out from one of the deepest housing holes in the country, right? So I mean, we're talking about a place where the average home price is still something like 40 to 45% below where they were in the pre-recession times. So I wouldn't be surprised if if consumer spending is a little bit slower in that region, in that state, and in that metro area, in particular Vegas, than it may be elsewhere. Of course, Vegas has this huge tourism injection, right? But that only really targets certain areas within the metro area. So I mean, for residential consumer spending and stuff like that, you might be seeing that the businesses in general just they're still waiting for their cash flows to return to whatever normal was before the recession hit, and that's probably going to take a little bit longer in Vegas than other areas in the West, and particularly in the Mountain West, the interior West. Mm-hmm. So where you've already seen the housing recovery just rocket past the national average, and you have house prices in cities like Denver that have already exceeded their pre-recession pace, which is that's really abnormal. So I think that it's interesting to see that Nevada is performing better than the nation, given that Las Vegas was so hard hit by the housing bust. But on the other hand, this may actually also play into the fact that bankruptcy rates are much higher in the West too. So it may just be that delinquent companies were basically just getting purged from creditors' portfolios and stuff at a faster rate. So
yeah,
it'll be interesting to see. Gary, can you specify for the state of Nevada the hospitality industry?
Yeah. I was actually just there. If I go into hospitality and then delinquency rate for the state of Nevada, and delinquency is practically non-existent at 0.33 for that industry.
Mm-hmm.
And so, bankruptcy 3.67 overall for Q1.
So yeah, significantly higher bankruptcy rate than what we're seeing across the country. Even for the hospitality industry, the overall bankruptcy rate was 1.63. The West was at a 1.62. So
oh really?
Okay. Yes. So significantly higher bankruptcy rate. This, I hate to use the term, but it's almost as if there's been a bit of a purging of the weak hospitality businesses in the state of Nevada, because that delinquency rate is extremely low for the hospitality industry at 0.33, where the West is at 3.99 for the first quarter of 2014. So almost seems like it has been where they've cleaned house for those fringe businesses. And anecdotally, I know it was a couple of years ago that in Las Vegas, you would look across the street and see casinos that had started construction, but it looked like the investors had totally abandoned any notion of continuing construction due to the financial crisis that we were going through.
Interesting stuff.
Now I wonder, looking at construction now, if that tells a different story. That's also another interesting thing. I mean,
yeah, let's pull up construction for Nevada, and 3.80.
The bankruptcy rate, and then the delinquency rate at the 18.66, which is just slightly below the West region at 18.95. but several percentage points below the average at 22.25 for construction industry.
Mm-hmm.
Interesting. So lots of churn, credit churn, I guess you could call it.
Right.
Yeah. Yeah, there was also some questions about comparing the delinquency rates in Ohio, and there was that one situation between Cincinnati and I think it was Columbus. Let me reset the map here, and we'll go out to Ohio delinquency rate. And switch to metro area. So they were at 15.69 in construction. Let me just pull up the overall delinquency for the state. And just bear with me, guys. So Ohio overall 15.39, and then if I switch.
Yep. Yeah, which is kind of in line with what the Midwest was looking at 14.73%.
Yep.
Delinquency.
And then Cincinnati at 27.33.
Yeah.
And if you look at Columbus, they're at 11.07, which is quite striking because of the vicinity of those two cities.
Well, I think a lot of that might have to do with Columbus being the state capital, and also the fact that it houses the university. So I've seen this in other metro areas that I've covered, where there's a large portion of employment and business activity that's conducted by government. They're typically more isolated from swings in the business cycle than other metro areas. Madison, Wisconsin is another really good example of this. I can speak to this a little bit more specifically, but the same points will probably carry over into Ohio. But being the Wisconsin analyst, I've always been kind of amazed where we just put Madison's business cycle in expansion from recovery, whereas nearby Milwaukee is still struggling to get out of its recession malaise. And I think a lot of that comes from the fact that you have funding going to the college, and not to mention government layoffs tend to be much less cyclical than other industries. So you may have a situation in Columbus where more people are able to retain their jobs, and these are relatively good-paying jobs too. I mean, especially faculty at university and other staff, and also state workers and stuff like that. I mean, these are people who are able to retain their jobs. So companies in Columbus were not as likely hard hit. Their cash flows weren't as as choked off most likely as they would be in somewhere in a place like Cincinnati. Another thing, I guess, you could say that you could extend that what's the word I'm looking for, by being able to hold on to more jobs proportionally in the metro area, the housing market is also going to go through less of a hit. More people are going to remain employed, which means fewer foreclosures and delinquencies there, which is going to keep housing demand relatively healthy. And I'm saying relatively because there probably was a hit there, just like there was anywhere else. But I mean, still, I bet you contractors and construction companies and stuff like that were still probably getting business during the time, whereas Cincinnati doesn't have as much of that. So that could be one explanation there.
Mm-hmm.
Any thoughts, Joel?
Yeah, no, I think that definitely makes sense. You can see that the stability of the government impact, those types of industries, where it will keep it from being negatively impacted. Cincinnati has been that trend that really started back in kind of the second quarter of 2013, where their delinquency rate suddenly was starting to emerge into at least the top 10 as far as worst delinquency rates by metropolitan area. And it seems to have just kind of held there since that time. And so when I'm looking at that, wondering, what potential impacts have happened for Cincinnati since that time, that it continues to be in such a poor situation. It'd be interesting to see if, you look at construction and even at the real estate industries for Cincinnati and for Columbus, because it looked like
Columbus number 3 in construction, and Cincinnati is 3rd from bottom.
So
in
you've
delinquency. Yeah.
So when you look at the rate there of so 38.3% again for the construction industry, we're looking at overall 22.25, so substantially higher delinquency rate, and then the average days beyond terms of 11.09. They're kind of right in line with that. So they're recognizing the same severity of delinquency when it happens, just far more of it in that case. And then their bankruptcy rate is pretty much in line with the nation. Nation's at 2.64 for the fourth quarter, and the Midwest being at 2.47, so slightly higher bankruptcy rate, and their overall trend seems to be kind of in line with what we've been seeing in the Midwest for that sector.
Mm-hmm.
Okay. If you looked at the real estate itself industry for Cincinnati.
Okay, and then there was something on here I had for regression TL. Is that happening also as part of the 6.7 bundled release? Okay, all right.
So real estate is, not as impacted.
12.0. Mm-hmm. But it's a little bit better than the Midwest at 14.79. But as we're looking at the overall delinquency rate, the real estate side has recovered quite well, going from that 24.63 back in the Q1 of 2013 versus the Midwest being at 15.39 in the real estate segment. So potentially some trends for Cincinnati. And Nate, are you seeing some of the things rebound a little bit for the Cincinnati area?
Honestly, I haven't looked too closely at Cincinnati for a while. That's a little bit out. We each kind of divvy up our analysis. We all have our special regions and stuff like that. So Cincinnati hasn't really popped out. Although, I mean that does strike me as one of two things, right? Either we've got some budding housing recovery happening there, or a commercial real estate recovery too, right? I mean, couldn't just limit this to residential, or bankruptcy for that particular industry picked up, and and again we're seeing some sort of cleaning out. So because I know that the housing recovery in general in the Midwest has been slower than most other regions. Northeast and Midwest have lagged noticeably but behind the South and the West since the recovery began. And I mean, that's not entirely surprising, because even before the recession happened, that was the trend. I mean, you had this migration of people moving from places, in like New England and the industrial Midwest, to other areas out west and south. And so, that population growth is really kind of propelling, faster growth in other industries. So I mean, it doesn't really surprise me that there would be lingering problems, with construction and real estate and stuff. But I mean, if there is some sort of rebound taking place, then I guess that would make sense. I mean, even a smaller rebound would probably help quite a bit.
Yeah. And delinquency is not always just a trend based upon the economic performance. It's also the reaction of the creditors and their tolerance for the delinquencies. So there could be some credit management going on that's impacting that significantly as well.
Sure.
Mm-hmm. Okay. Did you want to take a look at Philadelphia, and Pittsburgh? I think Pennsylvania actually was one of the other states that there were questions on. I'll just switch to state level here and get Pennsylvania up on the map. Okay, I've got to be good at my geography here.
Yep, there we are.
And I'll pull up overall delinquency. You guys see that? I'll switch to that.
Mm-hmm.
So it looks like statewide they're at 19.44. And going into the metro areas, I think there was some difference that we spotted there with Philadelphia and Pittsburgh.
Mm-hmm.
Pittsburgh at 11.91 and Philadelphia at over twice that, 25.18.
Yeah. That does seem to strike me as an economic difference, because I know that Pittsburgh is pretty much launched into expansion, and I know that there's been some really good high-wage job growth out there, which I'm sure is padding consumer spending, and I believe the housing recovery has been stronger in Pittsburgh too. Whereas Philadelphia has been kind of caught in that that trend of sluggish recovery that's kind of characterized places like New York City and other areas in the Northeast too. And I think that may have to do, at least in part, to the fact that finance has been really slow to come back in the Northeast, and Philadelphia, while it's obviously not as large as New York City and Wall Street. I mean, there is quite a financial services presence in Philly that probably is trying to feel out the new regulatory environment. And so there's probably, it's just there have been uneven recoveries across the state. And so I think that's probably at least partly playing a role in that, obviously revenues aren't snapping back as quickly for a lot of companies in Philadelphia as they probably are in Pittsburgh.
Yeah. Yeah, that's the finance view there. Pittsburgh's actually more delinquent in financial services than Philadelphia.
Yeah, I mean, I think what I'm saying more though isn't even so much that the finance industry is struggling on a credit quality basis. I think that in order to keep delinquency under control and to keep their costs manageable, they've been very slow to hire back people who were let go after the financial collapse. And so I think that that's really how that's flowing through into the economy, is just the fact that you've got, a lot of finance positions that would otherwise be filled, and obviously that's more paychecks and pretty good paychecks too. I would imagine, that we're just, and I say we because that's where I am right now. I think I even see my apartment right there on that map somewhere. But so I mean, being that I'm right here. I mean, I'm seeing it, I'm feeling it, and so until that financial services engine kind of kicks back up, and starts moving along in the Northeast, I think that businesses are probably gonna, I won't say struggle on the revenue side, but it's going to be a little bit more difficult for them to garner the revenues that they might need to get ahead on some of these debt payments, I think, probably for the next year or so.
When you're looking at Pittsburgh being right on the border between the Northeast and the Midwest regions, their delinquency rates are closer aligned to what we're seeing in the Midwest overall versus the Northeast. So it may be just part of the division lines for the regions that we're seeing, that Pittsburgh may be behaving more like a Midwest type city in some respects than it would be a Northeast type city, just because of their existing location within the state of Pennsylvania.
Right. Yeah, and historically that has been the case, right? I mean, Pittsburgh being the big steel town that it was, whereas in the Northeast, I mean, New York and Philadelphia were typically, finance centers and stuff like that. So I think that it kind of comes back into that industrial structure. So that makes sense that geographically and industrially speaking, that you'd see more similarities between Pittsburgh and the Midwest, or you start to see kind of like a movement, kind of like a gradation that kind of moves towards that, as you move further west in the state, for sure.
Right.
Yeah, that's a good point. Really good point.
Yeah, I was reading an interesting story yesterday from HSBC about exports in San Francisco and how it's the tech exports is really starting to thrive back in that region. I'm wondering if on the East Coast, if we're going to see some of that same success kind of starting to come back, because exports were hurting a little bit there in Q4, right?
Yeah, and that kind of depends on how quickly Europe recovers too in a lot of cases. I mean, I know that most of the exports that leave the East Coast, I mean, they're bound to move across the Atlantic. Another thing though too, I mean, they're upgrading the Panama Canal. So you know, from what I've gathered, there is some upside potential for southeastern ports to maybe be able to reap some benefits from that. So you know, that's one potential development to look after. But I would say that probably, yeah, most importantly, it kind of the Northeast in particular and you know, Mid-Atlantic ports. I think that those are going to really heavily rely on just how well Europe can pull itself out of its economic and financial woes.
Okay, so shall we give away some prizes? We had 3 people who were on our webinar, and we chose them at random. I'm going to reveal the names if I can get my screen share to work. You guys let me know if you can see the winners.
Yeah, we can see.
I'm going to show the winners. If I can show the winners. So, Marvin Broyne, Rodney Grizzle, and Margie Lindsay are winners of the Fitbits. And I guess these are really cool little devices that you put on your wrist, right? And they monitor your heart rate and even monitor your sleep patterns, which I think I could probably use some help with. So we'll be getting those in the mail in the next couple of days to those 3 winners. And try and I don't know if we're going to give those away at the next webinar, but if you've got suggestions on prize giveaways, we're all ears. We like to keep it interesting. Any closing thoughts, guys, on general economic trends? There were some things recently from Fed, and it was Janet Yellen had said some things about uncertainty, or at least that she used the word uncertain in her speech 8 times versus 1 the last time she gave a press conference. I wasn't sure if there was something that we should be reading into that or not. Any thoughts, Nate?
Well, yeah, I mean, first things first, you know, we kind of need to untangle what the Fed meant when they severely cut their growth forecast for 2014. A lot of that's coming from the fact that it looks like the contraction in the Q1 really threw a wrench into the works, right? I mean, that's going to pull the whole level of growth down for the entire year. So, you know, just to clarify and to be sure that everybody who's listening understands this, that doesn't necessarily mean that they've cut their growth forecasts for Q2, Q3, and Q4, right? So, you know, just to not get too doom and gloom on that note too quickly, it's just the fact that, you know, when you have a contraction like that, you're going to pull down the overall level of GDP, and so climbing back out, even if it's at the same trajectory, it's still going to be lower than where it would have otherwise been. But I would say that uncertainty has been a persistent issue throughout this recovery. As a matter of fact, I helped put together a policy uncertainty index with one of my colleagues, Ryan Sweep, and we also work with Mark Zandi on it too. And it's been something that's been gaining in importance because, you know, we're talking about a recovery that many people believe that the Great Recession was caused by huge systemic problems, you know, in terms of either too much regulation, not enough regulation, you know, I mean, but no matter which way you spin it on either side of the political aisle, everybody recognizes something was really, really wrong in the years leading up to the recession. And so now you've got this kind of snapback by regulators and policymakers to, you know, instill a new paradigm almost, or a new regime within, you know, the way business is conducted. And so, you know, you've got a lot of businesses and households even that are kind of reticent to really get out there and spend. I mean, corporate profits are at an all-time high, yet businesses are still sitting on it because there's a what-if mentality.
Mm-hmm.
Well, what we don't want to wind up where we were in 2008, 2009, and so they want to make sure that they know what to expect before they go out and start investing more heavily and start hiring new people on and stuff like that. And on the household side of that too, with the changes in the tax code and stuff like that that accompanied the fiscal cliff back in 2013 and stuff like that. I mean, people are just everybody's just trying to get a handle on what's going on, and so it's true that there is a lot of uncertainty as to what the future path of policy is going to look like over the next few years, and so we're still looking through and quantifying exactly how much that impacts the economy, but it's measurable. It is measurable, and so it's an important concept to get our heads around, especially at this stage in the game, where we're 5 years into a recovery that has been much slower than past recoveries. And yes, some of that does have to do with the fact that the underpinnings of the recession came from the financial collapse, and so any sort of financial hole is a lot deeper and tends to take longer to dig out of. But nonetheless, there are some other things that obviously need to be addressed before before the economy can start firing on all cylinders. So I think there has been a lot, and rightfully so, a lot more attention paid to uncertainty.
Yeah. Well, it seems as if because the interest rates have been so low for so long, that should have had some type of an impact on the investment by business in any type of expansion of production, fixed asset acquisition, whatever it might be. It doesn't seem to have had that type of an impact because, Nate, of what you were pointing out, that uncertainty of do I feel confident that if I expand production, I will be able to fill that and actually generate new revenue and that type of growth from that. And that seems to be the first question that has to be answered before you then start to consider, now what is going to be my cost of capital for that acquisition? And that always tends to be a secondary. So the interest rate tends to be something that helps to tip it in the favor of I will acquire a piece of equipment, but first you have to have that answer of, am I confident that if I buy this, I'm going to be able to put it to good use? And I don't know if that question has been, had a resounding yes, I can do this. Seems like it's been kind of sputtering, but that I'm talking anecdotally more than anything. So
I think auto has been definitely a benefactor, right, of the lower interest rates, and we've seen longer terms on the auto loans. So we would think a lot of businesses are making that investment in new trucks and vans for their fleet while they've got favorable interest rates.
Sure, and just to end this on a positive note too, a really good sign has been that business confidence, as measured by the NFIB or even by our own proprietary index that we run over here at Moody's Analytics. I mean, we're talking about business confidence is coming back and it's at recovery highs. So that is a sign that that it seems like the sense of uncertainty is starting to ease somewhat, and so that's a very good sign for I'd probably say the next 4 to 6 quarters for economic growth, and I think that obviously that's going to play into credit quality for businesses too. I mean, as activity picks up, right? I mean, that can't hurt. So and it can only help. So I think that on that note, there's still kind of a wait and see mode, but I think that it's getting a lot less so than it was, even 6 months ago, 9 months ago. That's a good sign.
Good.
Well, just flashing up the poll for the expectations for the Small Business Credit Index for next quarter, and there seemed to be general consensus over to 2/3 of the audience felt that we would be seeing improvement. So I think generally people are feeling positive on the economy. We've seen some good news coming out recently on jobs, and some good projections on jobs, plus 200,000 numbers. So I think there's a lot of reasons to be positive about the economy.
Sure. Yeah, I agree.
Okay, did you guys have any other thoughts? I know you're both busy. Well,
No.
on that note, unless there are any other thoughts or comments, I'm going to bring this hangout to a close, and we will do this again next time following our quarterly business credit review in Q2. And so thank you very much for joining. Thank you very much, Joel and Nate, for taking time out today to talk to us about this stuff and answer the questions. And again, congratulations to our winners. And we will see you all next time.
Thank you.
Thanks, Gary.